Ellen, thanks for being here with us. A very busy day and a busy news cycle.
Fed day.
Fed day.
Very
but
exciting.
we think we know what the Fed is going to do. We think they're going to sort of hold steady. But what should we be looking for from Joe Powell when he speaks to us?
Yes, I think it's really easy to expect that they're not going to move the policy rate at this meeting. So eyes are going to be focused elsewhere. Investors have been very concerned about the drawdown of the Fed's balance sheet. And then they were concerned when the Fed started adding back to its balance sheet that it would stop again. So here we are again, wondering when the Fed is going to stop these purchases to shore up reserves on its balance sheet. I think any more detail from Chairman Powell is going to be helpful there. Anything that allays those fears and says we're not going to stop purchasing overnight. Again, we said we're going to draw down purchasing gradually. We're not going to just pull the rug out from under, adding to our balance sheet. There's a lot of confusion around the balance sheet. It's difficult for the Fed to communicate around that and what it means. Investors right now believe that that is what has been pushing up risk assets. And so they're afraid that when that stops, possibly in April, that would stop that flow into risk assets. So it's created a lot of volatility.
Absolutely. And of course, the inflation has been something that Chairman Powell has been very focused on, or perhaps lack thereof, if it's not quite hitting that around 2% rate. What are you expecting we'll hear from him about that and what he's looking forward to?
So I think he'll continue to express frustration. Policymakers aren't quite sure why inflation is so stubbornly low. There are a host of factors, including technological factors, that are driving it lower, depressing inflation. It is a little bit of a gift at this point, though, because it's not pressuring them to do anything. So they've given criteria for raising rates and cutting rates. The criteria for raising rates is a near impossible hurdle, and that is that inflation moves convincingly back to and above, persistently, its 2% goal. That's a very tough ask. But in order to cut rates, it's anything that creates a material reassessment of the outlook, which could be a whole host of factors. And so we've seen over the past several days, and on the back of the coronavirus, more investors starting to assume that the Fed may be cutting rates before the end of the year rather than just holding steady throughout the year. So clearly investors are saying, you've given us a high bar to move, but the bar is a little bit lower, relatively speaking, for cutting than hiking.
And you mentioned it right there, the coronavirus. You know, there are some economists that are saying, actually, we've hit 5,000 cases of the coronavirus faster than we hit that in the SARS virus. Maybe this is going to be more serious than we first thought. Do you think Chairman Powell is going to mention that?
No. I think that economists have to be careful of trying to do the job of the WHO. That's not our specialty. It's very well known how these affect the economies. So as you were talking about Starbucks earlier, restaurants have to close stores, services are shut down. You tend to see a hit to the economy in the near term. And then when you get beyond the peak rate of the virus, then you start to see a rebound in activity. We never know how long that's going to take. The chairman has to be careful to not make some prognostication on what's going to happen here. What he can say is that they think they're sitting on a good outlook for the U.S. Trade is moving in a positive direction, but many unknown factors, downside risks still remain. And of course, you can chalk up the coronavirus as one of those. It's just too early to make a judgment on how you build that into your forecast.
That's very interesting. So even though if you are not going to a Starbucks because it's closed, or you're not going to the movie theaters because it's closed, presumably you're not going to make up those sales later.
Right. So there will be some permanent damage to the economy, especially in the services sector. But then on the other side of it, activity comes back. So when those factories open back up, I think for the U.S., in terms of spillover effects from economic activity, it's important to know whether China's exports are cut. Many of the factories, I mean, so far, a lot of the affected provinces are about 4% of China's manufacturing. So it's not expected that exports will drop by a good deal, which means our factories will still get what they need. But how long does this last, and how much do those linkages start to get affected? When do we start seeing more and more cases here in the U.S.? That's the unknown factor. But you do have to understand there is a rebound on the other side of it.